Well, for more on tariffs and potential risks to the market, we have Michael Sayers, Rockland Trust Vice President and Portfolio Manager. Michael, always good to see you on the show. So why don't we start with tariffs front and center, certainly helping to dominate headlines, say, Michael. White House saying an additional 25% tariff will now be imposed on India. So the total now there is 50%. How do you try, Michael, to try to sort of think through these trade and tariff headlines? How do you try to navigate them as an investor?
Yeah, well, thanks, Josh, for having me back on the show. I think for us, we try and do our best to actually kind of ignore the day-to-day, because, we know this is kind of going to be a constant, I think, of the Trump administration for the next 4 years or so. I think importantly, though, a big company like Apple actually seems to have gotten a carve out from that additional 25%. Higher for the tariffs on India, so that's very important to pay attention to. But for us, when we dig into our companies and dig into the fundamentals, that's kind of where we evaluate, on a case by case basis, which companies are going to be more or less affected by the tariffs, and then we just look for dislocations in the market if we think certain companies sell off more than they should based on tariff headlines, and that may be a buying opportunity for some of the stocks in our portfolios.
So for you, Michael, although they may get a lot of attention, the trade and tariff headlines, they don't change how you want to commit capital or where you want to commit capital.
No, not in the long run. We're long-term focused investors, really just buying quality businesses. So, for us, that's kind of our bread and butter. And on the margin, in the short term, sure, the tariffs will affect earnings in the next few quarters. But, once the tariff rates are finally set, and I think we are getting to the point where we're getting closer to the finalized tariff rates, then it'll be kind of a one-time adjustment to company earnings. And then from there, the longer-term fundamentals in those businesses can take over.
You mentioned earnings, Michael. Let's talk about this earnings season. You got another rush of names, of course, after the bell today. What have you learned about this earnings season? What have been your big takeaways, Michael?
Sure. So coming into the week, about 70% of S&P 500 companies have reported second quarter earnings. I think through today we'll be up to 80%. So in a word, the earnings season has been strong. About 80% of companies are beating estimates. And in the aggregate, we're probably going to see double-digit earnings growth year over year in the second quarter. So the headline has been strong, but I think when you look underneath the surface, things are a little bit weaker. If you look sector by sector, there's actually only 4 of the 11 S&P 500 sectors that are significantly beating their estimates coming into the quarter. So those sectors are financials, tech, communications, and consumer discretionary. And then in particular, most of the outperformance for those sectors is really being driven by the Magnificent Seven. So the Mag 7, on average, have delivered about 20% or more earnings growth this quarter, and the rest of the 493 businesses in the S&P 500 have really only grown earnings in the low single digits, about 2% coming into the quarter, and maybe we'll end up around 4%. But obviously, that's much lower than the growth that you're seeing from the Magnificent Seven companies.
So, Michael, given the backdrop, the environment we find ourselves in, let's look for some opportunities here. Let's get to some names, some picks. Why is McCormick a buy?
Sure. So McCormick Consumer Staples Company, this is a conviction position for us in that sector. So they've got a dominant position in the spices category. If you go into any grocery store, all you'll see is McCormick. So they're very resilient to the economic cycle. When the economy slows down, consumers tend to spend a little bit less on snacks in the center of the store. They tend to shop the perimeter more, buy more whole foods, and use more spices. They've also got good secular trends as well. People trying to eat healthier, eat better. There's also some potential upside from ingredient reformulation. They have a segment called Flavor Solutions where they work with companies to reformulate their ingredients and to give consumers more options, healthier options. And then finally, it's just a really attractive valuation. This is a company that traded at a significant premium to the U.S. food industry for many, many years. And just given how weak the staple sector and defensive sectors more broadly have been, in the market this year, McCormick is now trading roughly on par with the other U.S. food companies out there. And we think that this is a company that returns to a significant premium over time as their business is just that much better.
Michael, here's another one you like, TJX, which is up roughly about 10% in 2025. You say that one's going to keep moving higher.
That's right. So TJX, they own and operate not just TJ Maxx, but also Marshalls and Home Goods. And so well-known discount retailer. It's a great place to shop for consumers that are really looking for value. I think what's underappreciated about this one, though, is more on the home goods side of things. So if we do end up seeing, rate cuts start in September, and we see a reacceleration of that rate cutting cycle that is currently on pause, that home goods store could actually see a significant uplift there because that business is levered, not just to new home sales, but also existing home sales, and we could see that pick up with lower interest rates here. So we think that could give the stock an additional boost in the coming quarters if we see that.
One more name I want to squeeze in here, Michael, Copart, CPRT is the ticker. It is down about 20% so far this year, but you think that's an opportunity?
Right. So this is more of a contrarian call for us. Copart's very high quality business. They're in the car auction and salvage business. And, you would think that with all the technology going into cars these days that there'd be less accidents and those accidents would be less severe. It's actually not the case. Accidents are still just as frequent as they've always been. And since you've got so much technology in the cars, even a fender bender can result in a total loss for vehicles. So strong secular growth over time. The stock did sell off after they reported their most recent quarter due to concerns around market share loss, specifically Copart losing share to their biggest competitor, IAA, Insurance Auto Auctions. We think that was just due to Geico, which Copart does more business with, losing a little bit of share, some volumes to Progressive during the quarter. So we don't think that's a trend that's going to continue. We think that reverses. And so Copart's at a very attractive price here to get in for long-term investors.
Michael, appreciate your time and those picks. Thank you, sir.
Thanks, Josh.